Well, after the first note, I have also looked at the second note. So when we look at the second note, it is rather I was just browsing down into the balance sheet. What are the other items that I will have to put in? So before I go into the second note, I see that there is a long-term borrowing that I will have to make a note into, which is the debentures that I have picked up from the trial balance. The third item is the current liability, that is the short-term borrowings. In the short-term borrowings, I got the trade payables, which I have taken the sundry creditors from the trial balance as it is. No adjustments related to that. While you have got the other current liabilities out there and this note 2, which is given here, other current liabilities. What is the other current liability that I have still got to pay to outsider? It is the dividends that I will have to pay. So the dividend payable, which is 15,000 rupees, we have calculated based on 1,50,000, isn't it? That is where we have taken in the note 1. If at all you see the dividend paid, that is 15, which we have taken. Because every adjustment needs to have a two-time effect. So the first time we have already subtracted it from the reserves, and the second time we take it as a outsiders, that is the current liability we still need to pay to the outsider, that has been taken here. So that's the note number 2 that comes here as 15. Now if I see that all my liabilities seem to be complete, but then when I look at the bonus shares, I have only calculated the bonus shares and I have subtracted the bonus shares from the reserve, but I have not yet taken into the capital. So let us see the next item, note number 4, which tells you about how the treatment, the second time the treatment for the bonus share has to be done. So the share capital that we had given in the trial balance is 150,000, while we said that the bonus shares are going to be issued at 50,000 rupees, which is calculated here. So we have come to an amount of 50,000 rupees and we have already subtracted that 50,000 rupees of bonus shares here. That is the one time effect, and the second time effect, it goes and sits in the capital account. So the capital which was 150 earlier, now you add up this bonus shares of 50,000, becomes a total capital of 200,000 shares, 200,000 rupees. And that is the fourth note which comes and sits here in the share capital. So the share capital earlier was 150, now because of the bonus share it has become 200. When I add all these items in the liability, I come across a total of 541,000 rupees. Now, what does the balance sheet say? The assets and the liability should have an equal amount. So let's see whether the assets also fit into this. So here we go with the assets. So in the case of assets, we need to refer to the debit side. So in the case of the assets, the debit side, we find that the land at cost is 110, but you remember that we said that land is going to be revalued. While we were revaluing, we said that 70 rupees of revaluation reserve is to be taken here in the liability. At the same time, the land which was 110 now becomes 180. It is revalued at 180. I have made a note of that in the assets. Let us see here the land. Land was how much? 110, and I add 70 into it, which is because of the revaluation, and that comes out to 180 here. 110 plus 70, which is the revaluation as increase. Now coming to the plant and PPE, that is the property, plant and equipment, of which we will talk about the plant here in note number 3. The plant is 385,000, which I have picked up from the trial balance. And remember that the adjustment said that you have sold a plant of 5,000, sale of plant at the beginning of the year, and that you have sold away. So you have got how much with you? Now you have got a total value of 385 minus 5. You have got a total value of 380. And you said that whenever the asset is being sold, the accumulated depreciation also needs to be removed. So what's the accumulated depreciation that was given in the trial balance? The accumulated depreciation that was given in the trial balance was 86,000. From the 86,000 of accumulated depreciation, we remove this 4,000 of accumulated depreciation. Refer to this point where we were talking of the accumulated depreciation on the asset which was sold is 4,000. Because the asset is sold away, even the accumulated depreciation also has to be removed. So what am I left out with? From 86,000, remove 4,000 rupees, my accumulated depreciation is 82. So into this accumulated depreciation, whatever depreciation that has been charged in the current year has to be added. So 82,000, you add up the current year depreciation of 38,000. How did we get this 38,000? We have already calculated in note number 5. That 38,000 rupees has to be added to 82,000. So what's the total accumulated depreciation? 120. So now when you display or show this item as a line item in the balance sheet, you need to take the net value of the plant. So the net value of the plant is 380 minus the accumulated depreciation of 120 till the end of the year. So that shows up to 260 as the amount. 380 minus 120, 260. And what's the value of the land? Which is 180, which has been revalued. So total fixed asset works out to 440. That is your total plant of 260 plus a total land value of 180, which totals up to 440. That's note number 3, and we have taken this note number 3 into the asset here. Total fixed assets. Now, do we have any other tangible assets? No. Now, coming to the next item, the inventory. What's the value of the inventory, which is already given in the trial balance? The value of the inventory should be in the trial balance. That is the stock, 43. Then you have got the receivables, 48. And we have got the bank balance of 10,000 rupees. So, cash and bank balance, cash and cash receivables. Cash receivables, which is 10. So, we take this 10 here. So, put together now you have got a total amount of fixed assets 440 plus a total amount of inventory 43. Trade receivable 48 and the cash and cash receivables are 10. Put together it is 541, and that is your total balance sheet. So we have gone through the entire amount of entire process of preparing the statement of P&L and the balance sheet as according to Schedule 3 of Companies Act 2013. While the problem that was given to you was of 1997, that was a hypothetical number that was given to you, a hypothetical year that was given to you, but you were expected or you are expected to prepare a balance sheet as per Schedule 3. Right. Thank you for being with me. I'll come back to you with another video session.